we're live and up and running here. So 5 o'clock, we're going to get things going. And for those of you that tuned into our last webinar, Will and I, we've triple checked the technology. Everything should be going smoothly here. So hopefully no issues on that front. But anyways, appreciate everyone tuning in. It's obviously Wednesday, November 17th. The name of the webinar today is Fed tightening, U.S. midterms, and inflation easing. So for those of you that don't know, my name is Greg Wise. I'm here with Will Simpson, and we have lots to unpack today, lots to uncover. It's obviously been an interesting period of the markets. One thing I also just want to say, this will most likely be our last webinar that we host before our client event that, we've sent some correspondence out for December 7th, Wednesday, here at First Canadian Place. So, I think we can all agree we'll be looking forward to meeting in person and doing this live in a few weeks. But before we kind of jump into things on our end, just want to remind everyone, if you do have any questions, comments, things that you want to add, feel free to just put it in the chat box. I'll make sure to kind of, include you into the conversation. And before we get going, Will, anything you want to add?
Yeah, I mean, it's the in-person client event. I mean, that's our first one in years, certainly, at least that our group has put on post COVID, if we want to call it that. So, we're looking forward to that. I think we maybe have a little bit lighter, a little bit smaller group on the webinar today. Maybe that's because people are getting ready for the actual in-person, the real thing. But looking forward to that. It's a little bit, in general, I don't want to say it's been that way really at all this year, but it's been a little bit quieter and calmer in the markets the last couple months. Not quite as much noise overall, which is not necessarily a bad thing, but we usually don't have quite as many people on these when the markets are a little bit quieter. So that's not a bad thing. But yeah, looking forward to diving in and talking about what's going on out there and getting into things. And if anyone has any questions, any comments, anything they want to talk about, feel free to jump in the chat and just let myself and Greg know.
Yeah, awesome. Okay, so I guess first question, well, just to jump into things, obviously it's been a pretty good period in the market the last few months. October was a really, really strong month, especially for the Dow. We've had some kind of carryover and carry through into November. So just curious to kind of get your thoughts and just make sense of kind of where we stand, in the market, but also kind of the broader economy.
Yeah, so I mean, market wise, as you got to late September and it kind of carried through in the middle of October, you had sort of a shakeout, a bottoming process, right? It was definitely a new low that we hit on the markets in the year, and then what you've seen in the last, call it, month or 6 weeks, right? And I mean, there's been a few bumps along the road as a nice little rally. I mean, it hasn't been as significant or as sustained as, say, what we had in the summer, or what we had, so let's call it pre 2022 when you had market rallies. But we've had a nice little movement up, which is good to see. I think investors are happy to see that. A lot of that is on the back, especially more recently, of better, some more encouraging economic data. I mean, there's still rate hikes going on. There's still going to be more to come overall. There's going to be another one from the Fed in the U.S. in December. There's probably another one coming in Canada in December as well. There's one in Canada that came in October. So there's more of these coming. The pace is slower, and the inflation numbers are improving, and that's the big thing, is the rate of change is improving. Inflation is still very high. It's still too high. It needs to come down. But when you're seeing those numbers go in the right direction, that's a good thing. And that's one of the big things that spooked the market, say, in September, late August. Late August was sort of the hawkish or negative Fed talk from Powell. And then you had stronger than expected inflation numbers, which really started to roil the markets in September. So now we're seeing stuff that's better than expected. I mean, you're still in the 7% range for inflation, and we've got some we've got some visuals today, right? Which we'll share in a bit, which is nice since the technology is working. But the inflation numbers are improving. I think probably one of the things that we'll need to see is you still have sort of rates down here, and you've got inflation down here, and the gap is closing. But you probably need those to equalize, right? Or even the borrowing cost and the interest rate to actually exceed where inflation's at before this thing gets put behind us. But it is moving in the right direction. If that gap was widening, I think that would be a bigger issue if inflation's running away. But it is tightening up, which is nice to see.
Yeah, it's always a positive. And to your point, we have gotten some good economic data. So, CPI in the US came out, I believe it was a week or two ago, under expectation. Producer price index came down. I mean, these are only one data points, but it's showing a good trajectory. The Bank of Canada recently only raised rates by 50 basis points when previously it's been kind of 75 or 1%. So all good signs. So would you say that's primarily been the catalyst for some of the strength that we've seen in equity markets over the last 6 to 8 weeks?
Yeah, I mean that, and also when you know just when the market's fallen very far, very fast, right from the middle of August to the end of September, the markets took a big dive down. It's almost like ballistics in some ways, right? That there's going to be a bit of a bounce back, right? So there was sort of a test or retest of the low, which we saw, and then we've seen a bounce back. But it's not given the environment that we're in, right? As long as you've got inflation high and you've got central banks tightening, it's not going to be a smooth ride for equity markets. I mean, the other good thing is a lot of the macro data that's come out, right? You had, especially in the US, you had two negative quarters in first and second quarter, and then the third quarter numbers were actually fine and pretty normal. I mean, that doesn't mean things are not slowing and easing up, and you're not seeing issues that are showing up in the economy, but it's still better than expected numbers. So it's not like these rate hikes have already thrown the global economy into a deep recession, but the rate hikes probably will take 6, 12, 18 months to work their way through the economy. So there's still this whole thing is still very data dependent. There's got to be more information that comes out, but as we've said many times in this, the market is very, very forward looking, and all of the economic data and a lot of what you're seeing in the news as well is going to be very backward looking. So the market can move far and fast before there's really any positive news that we're seeing out there.
Yeah, no, that's a good point. So I guess just overall, so we're getting some positivity on the stock market side. We're getting some good news on the kind of the economic and that sort of side of things. So overall right now, what would you say just the risk level is? Like, are we heightened, low, medium? Kind of where would you gauge that?
I mean, it's still high. The one thing I would say is that from a shorter term perspective is the markets have had a rally, and it's gotten a little bit. They've moved pretty far, pretty fast. I don't know if I'd say they're really overextended, but they're on the side of probably have gone a little bit too far, too fast. And you've seen the last few days they've come off. So I wouldn't be surprised if we see a little bit of a pullback here. I mean, our positioning for the last little while has been more in the range of yellow light. I mean, if you look and really unpack our managed accounts, they're pretty defensive on the whole, and that just goes for overall positioning, but also the types of equities and the types of names that we have. They're going to skew to the defensive side, but a lot of that's based on relative strength and what types of names are working, which we can get into more. But I would say there's certainly still elevated risks out there. We see that in a lot of the longer and medium term technicals. There's a lot of resistance, basically meaning selling pressure that's packed into the market. So I don't think it's smooth sailing yet. If you stretch that out longer term, though, I can give and have a more optimistic message about where things are headed for sure. So it's not to say, oh, it's murky right now. So that means, markets are going to get, cut in half or go down another 30% from here or anything like that. It just means there's still a lot of headwinds out there, right? There's still a lot of clouds and noise that we need to work through before, the market starts to go on a real sustained upward trajectory.
Yeah, and we've seen that a lot this year. Like the first time was kind of through March and then through the summer. And then kind of what we're seeing now is, you had kind of a big sell-off and the market has recovered, fast, sharp, aggressive, and then you've seen things kind of peter off. So that trend has been consistent all year. So, with our approach, we're looking to, play defense at those times. So I guess, well, yellow light positioning, what does that, if you unpack that, like what does that entail?
I mean,
Just
look, we're gonna hang on to higher quality names. So, a lot of the technical work, we've got relative strength leaders. So, we've got things like energy names, we've got healthcare, we've got consumer staples, right? It's a lot of low volatility defensive type of positions. It's also value names, right? Like the weak relative strength side of things is the growth equation. And not that you can't have, you know, growthier type names in your portfolio. There's just a lot of headwinds for them, right? That's where, when you see a big day, clients, we had a few clients ask, oh, the one day the NASDAQ was up 7.5%. I think that was last Thursday. Well, why aren't we up that much? Well, we don't own the NASDAQ, and that's why we're not down 30 odd percent or 25% or whatever at this point. So, the NASDAQ stuff is what's carrying the most risk. You can have some of it, but in my opinion, you want to stick to the higher quality names, right? That have, real, quality earnings, quality, business models, right? Are not egregiously overvalued, haven't taken the big hits, right? They're still going to be down. Like Apple is a good example of, one of these really high quality names through this that we own in all of this. But really just sticking to high quality names. We've got higher than normal cash balances. We've got, more than I would say normal defensive players, but we're not uninvested, right? We've got a good portion of the portfolio that's invested and still participating in the markets, because you're going to get rallies like we've seen, in the last, 4 to 6 weeks in the markets, and we want to participate. And we also don't know, where the bottom is. We just will wait for more confirmation from markets. So we haven't seen that yet. We're waiting for it before we are at this point more more, I would say, aggressive or more opportunistic in terms of equity type positioning. But it's relatively defensive positioning for a yellow light stance.